What's up, everyone? It's Caddy with MoneyVest. So Enphase here, dropping like a rock. Literally, you take a rock and you just drop it, and that's how fast it is going down right now. Double digits. Last time I checked, down 14-15%. We'll take a look at the earnings in just a minute. We've got lots to unpack, and the higher interest rate environment absolutely crushing guidance from a lot of these companies. And we've been talking about it in our Discord. I just got done kind of sharing my quick reaction. So again, if you want to go over to Discord, you can read that. And I'm also going to go over an update I sent out back in August. Okay, so August 3rd, more specifically, I sent out an update in our Discord, kind of going over how I think it's important to be a little bit more defensive now going forward. But the only mistake I made was obviously going not somewhat heavy. Like, I personally am only getting started with Enphase. I've got a couple hundred shares, but that still hurts a little bit, right? So of course, buying in the 120s, 130s, and now it's already down 15-20% after hours, and the overall position's obviously down 30%. So definitely does suck a little bit, but it is what it is, right? That's part of the market. And look, in the short term, there's going to be a lot of price volatility, right? There's going to be a lot of back and forth in the short term, but as long as you are focused on the long term, and by long term I mean 5 years, 10 years out, because there's two things that are at play here. And I want to preface by saying that because the higher interest rate environment, in my previous videos, I've tried to emphasize on this point that a lot of these companies, including Enphase and Tesla, have never experienced interest rates as high as they are, right? This is for the first time they're going through a time period where yields, the treasury yields, are trading as high as 4.5%, 5%, 5.5%. Interest rates are as high as 5.25 to 5.5%. First time in their business cycle, they're going through this time. So of course they're going to get affected by it, right? Of course, discretionary demand is going to start to pull back, and this is very clearly being shown in the earnings from Tesla, the margin compression, the price cuts, and Enphase's guidance. All these are indicators for how higher interest rates are affecting companies like these that are dependent on consumers, discretionary, and financing, right? Those three things kind of come together, right? It's the consumers, discretionary spending, and also financing, right? All these three things come together, and that's what's hurting a lot of these companies' earnings. And as a result, they're dropping like crazy. I mean, Tesla, was down over 9%, 10% after the earnings as well. Enphase here dropping over 12-15%. And I specifically mentioned in our Discord two things, right? Over the long term, if you believe that interest rates are going to be lower and renewable energy and renewable sort of storage and battery technology and solar is going to be the future, then there's absolutely no need to panic. Yes, it sucks. Yes, it kind of is terrible and it's brutal from an earnings standpoint, from a guidance standpoint. The fact that the stock is down over 14%, trading as low as $82, but there is going to be price volatility, right? If I were to go over every time Amazon, Google, or Meta, or Apple, or some of these big tech companies were down in their lifetime, ever since they've been public, this has happened so many times. I mean, Nvidia, for example, has sold off so many times over 80%. This right here was a sell-off of over 69%. This right here was a sell-off in 2018 of over 57%. Right? So we can go on, and the idea is that don't let short-term price volatility kind of dictate what's going to be the long-term future for that company. Yes, the guidance does suggest a flat year for Enphase. We'll go over the numbers here in just a minute. I've got them open right over here. But just keep that in mind, right? Because interest rates and macros are certainly playing a bigger role in overall Enphase's business model right now, which obviously is unfortunate. But this right here is something that I mentioned back in August 3rd, 2023. I specifically pointed out to the idea, and August 3rd is, again, you can go back and check where the markets were, basically mentioned that I will consider shifting allocation more defensively for the second half of 2023, primarily for the bigger positions like Meta, Tesla, Google, after hundreds of percentage of rallies, and to something more like a value ETF or a high yield ETF, or use that cash to sell puts. Bottom line, we have seen the rallies in the first 6 months, the marginal upside, so how much upside there is, versus the downside risk is tilted dramatically, right? If you're over allocated, under allocated, valuation is a concern for you, it's a good time to think about rebalancing. So a little bit more defensive positioning from back in August. And primarily the reason was because the valuations had already gone up too much. They were too high, and of course big tech was trading at an expensive valuation as well. So if you come back, this update was pretty much around here. August 3rd, and not to mention the markets have obviously sold off quite a bit, right? So 8.5% from those levels, not to mention NASDAQ also has been pretty brutal. So August 3rd right here, down over 10%, 11% from those levels. And look, it's a constant analysis of valuations. I'm not saying, this is going to play out every single time, because I've been deadly wrong on Enphase when it comes to valuation, because the only thing that I have not foreseen is the amount of risk it carries with higher interest rates. Because like I said, this is the first time the company is going through a time period of such high levels of interest rates. So that's one of the things that I've not been able to fully comprehend in the Enphase analysis, is how high interest rates are going to affect demand, which obviously is being shown in the actual guidance for the company. So that's going to be an ongoing process for us, right? So I have to understand better, like in terms of interest rate expectations, right? It really comes down to more of a macro analysis at the end of the day to kind of figure out, okay, where rates are going and where's going to be that top, and where are we potentially going to start to see rates come down, which is not only going to help Enphase, but it's going to help the overall market as well, because it's not a fluke, right? It's not a surprise that since July, NASDAQ is down a little bit over 13%, and not to mention the yields have continued to move higher, right? So if you take a look at since August, if you take a look at since September, if you take a look at since October, and even go back as far as July, right? July we were at 3.7, right? So rates have gone up 32%. It's not a surprise. It's not a fluke, right? That the NASDAQ is down 11, 13% from those highs. This is how markets work. The yields are impacting a lot of companies, right? Higher interest rates are going to impact a lot of companies. It's not just Enphase. Enphase just is an example. It got caught today because it reported earnings. Google. Why was Google down, right? Google reported fantastic numbers, right? Meta. Why was Meta down? Like, Meta reported some amazing numbers. It's down 3.7%, right? Barely made the day alive, on the day. And it's because higher interest rates play a bigger and bigger role as they continue to move higher. There's going to be more and more risk involved with higher interest rates as they continue to go higher, right? So valuations are going to become increasingly more concerning for the company. Now, look, Enphase's numbers may drop in terms of the earnings expectations. So if you come over to the numbers here, so revenue did decline year over year, quarter over quarter also down, and then guidance, right? That was a big problem, because they guided for about $350 million. So if you come back up, so fourth quarter guidance to be in $350 million for the company, which obviously is about a 50% lower on a year-over-year basis. So I'm actually quite surprised that Enphase is only down 15%, to be honest. Like, this was not the best quarter. Earnings were not that great. I would definitely give this like a C plus, or maybe like a D plus or a D minus or something. So the earnings were pretty brutal. So again, like I said, macro is a big challenge for a lot of businesses right now. But going over to Amazon, Amazon better than expected results. Revenue jumps 13%. So EPS coming at 94 cents per share versus 58 cents. Revenue came in at $143 billion versus 141. And Amazon Web Services coming in at 23.1 billion. That's down from expectations were 23.2 billion. And advertising with a huge beat of 12.1 billion versus 11.6 billion dollars. And this right here, of course, Amazon's advertising revenue tops $12 billion in the third quarter as well. I think the company is higher after hours. It's pushing up a little bit over 3% last time I checked. So look, even Amazon, right? Beat on EPS, beat on revenue, beat on advertising. Cloud was flat with consensus, only at 1.7%. I mean, we are dealing with a very, very ruthless market, right? You can come out with the stellar numbers, report some fantastic stuff, and the stock will still not respond. Basically, Microsoft, right? Prime example. It was up significantly, right? Think about it this way. If a company reports A++ numbers and it still fails to rally, right? Sells off yesterday, sells off today. Think of what will happen to companies that report really bad numbers, like Tesla or Enphase. Game over. Like, it's literally game over for them, right? Because, of course, Tesla was down 15% last week. This week, it's down another 3%. And Enphase, I mean, on the weekly chart, it just looks brutal. Down a little bit over 20% last week. It's most likely going to be down another 20% this week. So that's the kind of market we're up against, is that you can report fantastic numbers and the stock will move 1% higher, and you can report mediocre or bad numbers and the stock will drop 16 to 20%, because we're coming up against very, very high interest rates, and macro is going to be increasingly more important as we progress. So that's where we are. This is what the heat map looks like, right? So we did an analysis earlier on market rotation. So I think there is a little bit more rotation happening out of tech over to more value, something that I again mentioned in Discord back in August, that I think is really important to kind of rebalance a little bit. and move more towards value. And this is where we are on the day. So real estate performance very, very strong coming in. So this right here is going to be the futures. Again, very strong markets in terms of the Dow Jones pushing higher. Of course, we did have natural gas, cocoa prices, wheat. We got soybeans, Nikkei, NASDAQ, canola, soybean oil, sugar prices, everything moving down. And then finally, cryptos, 34,000, so a little bit higher. And then we also got Ethereum just a little bit under 1,800 as well. So coming back over to the markets, yeah, so I need to figure this thing out. I don't know what's going on with TradingView's new feature. All these updates just keep blocking my charts. I think it's super annoying. But this right here is going to be that analysis that we have already done. So S&P 500 obviously breaking down further from the daily chart that we have talked about in our previous videos. So S&P 500 here. Selling off with a huge breakdown. We talked about this in one of our previous videos as well. So the next support, unfortunately, is going to be sitting roughly down at 4,000, right? 4,000 is also my fair value, my intrinsic value on S&P, something that we have talked about in our previous videos. I calculated the intrinsic value for S&P, and that sits at around 4,000 points. Talking about the NASDAQ, and NASDAQ here also breaking down below the 200 simple moving average. So technically, I mean, we are breaking down a very, very critical area of support, and the next support is going to be 12,267. So, like I said, this is a very ruthless market. We are up against significant price volatility, not to mention valuation risk. And next support is going to be down to 12,267, 12,250 levels for the market. Talking a little bit about Apple. Apple also struggling, down over 2.5%. And the next support is really going to be down at the lower lows over here in the 160s, all the way down to as low as $157 per share for Apple. And Amazon obviously is pushing higher a little bit. And look at that. Amazon also giving back on all of the gains here. Only up 70 basis points. Like, come on, this market. And this is totally normal. Like, look, we've talked about this, right, in our multiple videos where this is going to be challenging. We're not out of the woods, as I've tried to repeat myself over and over again and trying to emphasize on the point that until we see a confirmation for an uptrend, we're not out of the woods yet. Right, this is still very much in a downtrend. We do those technical updates on a weekly basis, and we point out to the fact that there's a lot of companies still in a downtrend. There's still a lot of weakness brewing within the market, and big tech, since they have seen significant rallies, they're starting to kind of again pull back and see that correction off of higher interest rates. Amazon's pretty much flat now, giving back on all the gains. Tesla, on the other hand, down a little bit over 3%, so coming back down to that support. Now, look, I wouldn't be surprised if Tesla breaks down below $200. It looks incredibly weak, and again, higher interest rates leads to lower potential prices for a lot of these growth companies, for innovation companies, and for companies that are very, very in the discretionary space. Talking a little bit about Meta platforms, and Meta here on the day also dropping a little bit over 3.7%. So again, selling right back down, and this is the higher high and higher low pattern, but of course starting to break back down. Support level is going to stay put roughly at around $275 per share for Meta platforms. And talking a little bit about Netflix. Netflix here also consolidating sideways, just down a little bit close to 2%. $403 is where we're at. Resistance is going to stay put at $452, and support level is going to stay put at $348 per share. At the moment, we also do have a gap to fill on the downside, of course. Talking about NVIDIA. And NVIDIA also coming down in the low 400s. Like I said, wouldn't be surprised if it does break down below this level, which I think is possible for NVIDIA. And if you do break down, then I think the 200 SMA with this gap fill is very much a possibility, and that's going to be $350 per share for NVIDIA. And right now we are once again in this consolidation pattern. You could also argue that there's a little bit of a head and shoulders, left shoulder, right shoulder, and a head over here with the neckline setting at low 400s, which if you do break down, like I said, 200 SMA and low 350s is possible. AMD breaking down 2.5%. So there we go. Next support is going to be in the $80 range, and that's really where we are potentially headed from a technical standpoint. And this is a lot of technical breakdowns, and it's very normal. It's very normal. This is not something that we haven't seen before, okay? So if you are somebody who's panicking right now and kind of think the markets are selling off, like the sky's falling apart, it's not something that's happening for the first time, right? We've kind of gone through this. It's crazy because 2022, I was saying the exact same things, right? In previous bear markets in 2020, we were talking about the same exact things, right, on YouTube. Like, we've done this analysis over and over again, where prices do move higher, they also can and will move lower as well. So low $80 is going to be for AMD. And I do have a starter position on AMD, and we'll be looking at selling some puts and buying more shares at close to $80 for Advanced Micro Devices. Talking about PayPal, and oh man, PayPal ended up green. What? How is that possible? Someone wake me up from this dream. PayPal up 0.5%. Surprisingly, I mean, NASDAQ was significantly down. We had the S&P down 1%. NASDAQ was, selling off a little bit over 1.7%. So it's kind of surprising to see PayPal actually push higher on a day like today. But it's had its fair share of selling pressure, and the next support obviously is at $51. So this right here is going to be that level to watch. And of course, earnings are coming up on November 1st. So that is going to be very, very important for PayPal, of course. The next support is going to be down in the 44.50. We'll see if it actually ends up at those levels or not. Visa here also struggling, down over 2.3%. So a little bit of a head and shoulders with a neckline sitting roughly at 228. So that's going to be that level to watch. And if you do see a breakdown below this level, next support is going to be down all the way to $210, $211 per share for Visa moving forward. So a little bit of a head and shoulders at the moment, and resistance is going to stay put at 250s. Talking about Google, and Google here also selling off, down another 2.5%. So continues to show a lot of weakness and selling pressure. Support level is going to be at that 200 simple moving average. So that's going to be that next level to watch, in line at 117, with a resistance closer to $126 per share for Google moving forward. Talking about Microsoft, and Microsoft here also selling off. Like I said, the entire gap is now filled. We are done. Next support is going to be down in $310 per share for Microsoft. And finally, we come over to Costco. And Costco here is basically flat at the moment. And, we've been analyzing this. Resistance is going to stay put roughly at around 547, 550. So in line with this red rectangle, support level is going to stay put at $531. So, this is where we are. There's a lot of headwinds. There's a lot of, I think, potential challenges with the market with respect to higher interest rates, and something that, we've been talking about for months now, that it's going to be now is the time when higher interest rates actually start playing a role. Up until at this point, it was just, rates are going higher, 25, 25, 75, 50, whatever. But now the problem begins when rates start to stay higher for longer, right? And if they stay at these levels for longer, right now it's only Tesla and Enphase. Eventually, it will be Apple, and it will be companies like Amazon, potentially other companies that start to kind of get caught in that environment where people are not spending on those things. I mean, I would even argue that Apple is struggling at the moment with their demand for iPhones, right? It's not that high. There's concerns that, Apple's iPhone 15 Pro and Pro Plus and whatever, the new models, are not selling as well. So higher rates going up is not the problem. They're staying up is the problem, which I think is going to make it very difficult for the market to find any type of floor, any type of momentum back higher until rates start to move back lower. I think that's going to be the most important leading indicator, which we've again talked about multiple times. So hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like, and don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to everything. As always, happy investing, and I'll see you all in the next video.